for the time being. That stock's holding more or less steady. Another big gainer in the last few years has been Linde. The stock is up 5-6 times, I think, in the last few years. Well, the EBITDA number was down by close to around 4%. That one normally gets bought on dips for the time being as well. That's U-turn from the day's low. It's well in the green. MTAR Tech, well, you had the EBITDA number that was down by close to around 60% approximately. So that stock comes up for you in the screen. You had the margins that came in at around 13%. That compares with around 25%. The street doesn't like it one bit. The stock is down in today's session. Capacite Infra, well, you had a reasonably good set of numbers. The stock, remember, had run up in the last few days, but that one's holding well in the green, I think. So it's up close to around 2% in otherwise wobbly market. And CMAC is another stock that's holding well in the green on the back of good numbers that we saw coming in there. A bit of a turnaround quarter for that company as well. Add to the list NBCC. That stock, in fact, is holding in the green with a gain of around 2%. Margins coming in at around 6%, compares with 3.5%. The street loves that. Up 3% as we speak. Prashant.
All right. Sorry, beg your pardon. Paytm is up 5% and it's got volumes on it. So 360 on Paytm. Started tentative and then it's, of course, moved up from that point on. Ritu was just telling us about that story. We'll revisit that a little later. You got 3M India, which is up 4%, 4.5%. It's the number 2 largest volume traded name, 3M India. Hardly ever figures on the list with these kind of volumes, but it is this morning. Brigade is up 5.5%, so it's a big one, 1260. Again, huge volumes on Brigade. I think we did mention Campus after number 6% on Campus, so looking good. Capacite Infra, that's up 1.6%, started to sort of perform once again over the last couple of days. Gensol Engineering is up 2.6%, back above the 4 digits now, 1,035 on Gensol. Torrent Power is up about 2%. And I think you've got GE Shipping, which starts about 3% or so in the green. Sumitomo Chemicals, big day, sort of decent move yesterday. It came off the day's highest point. Actually, in the last few sessions, from $400, stocks moved up to about $450 in, I think, about, 10 odd trading sessions or so. So it's been a pretty good ride for Sumitomo fairly recently. PNB Housing, of course, is the top volume-led cut. It's down 7.5%. So 729 on PNB Housing. And Cochin Shipyard is down 3. IRCTC we mentioned. Inox Wind after yesterday's large cut is down another 7%. Stocks at about 137. Inox Wind has got very, very large volumes once again. IRDA, EIL, Nigel mentioned. Loda, that is Macrotech, is down about 3.5%. Aster DM numbers, Ekta mentioned that, 3% down. Nazara is down about 3% as well. Nazara, again, last 2 days has had a decent run-up. So just about under a 100-point cut is what you have, 22,791. So we'll sort of get back with more names and market trends, etc. But for now, let's welcome in Mihir Vora, Chief Investment Officer at Trust Mutual Fund. And he's joining us in our studios. Always good to see that. Mihir, great to have you with us here. Good morning. Thanks very much for your time. CLSA this morning is talking about 54 Modi stocks, 54 companies which are perceived as direct beneficiaries of PM Modi's policies, half of which are PSUs. I'm sure you've seen that report. Lots of those names: L&T, NTPC, NHPC, PFC, ONGC, etc., etc. What do you make of something like this? It's, of course, a lot of interest about what can do well if the market's base case does come true on Tuesday. Your thoughts, Samir?
Certainly. See, the markets are hoping and looking forward to continuation of the existing policies, and the biggest thrust of the government has been to try to create as much as physical assets as possible, especially in the manufacturing space, but that needs to be supported by infrastructure and real estate, etc. So I think a lot of the PSUs in the space, utilities, the defense manufacturing, the railway-oriented stocks, some of the lenders to the infra, all of these fall into that broad, physical asset creation theme. So to that extent, I would not be surprised that if there is a, continuity of the regime and the expectation and the market's, outlook, which is more of the same, and maybe acceleration of the investments theme, then these are the kind of names which would, do well. I would not restrict it to only PSUs. Of course, some of the PSUs are relatively cheaper, so there may be scope for some more re-rating. But in general, I think the fact that the policies should continue and all the thrust on manufacturing and infrastructure should continue is something that will be welcomed by the market once this question mark or uncertainty is past us.
Okay, well, for now, the market is down about 0.5%, but there are several stocks which are bucking the trend. So don't lose sight of that, especially the real estate names. Just look at that. Brigade Enterprises is now up almost 8%. Of course, there's been, a lot of positive news flow on the real estate space as well. Then something in the capital goods space, Thermax is up almost about 3%. Torrent Power is up, Godavari Power. A lot of these companies, right, looking pretty good this morning. So, yes, there are stocks that the street still likes despite all the volatility. Mir, thanks for joining in on the show. I wanted your thoughts on once the election, verdict is out of the way and the market moves on, right? In all likelihood, of course, it will move on the upside. If yes, where do your preferences lie now? What are the pockets you think have still value and growth?
Basically, as you know, we've discussed this so many times that the local economy should continue to grow much better than the rest of the world. While probably the US is doing much better than expected, we still will be the fastest growing economy in the world, the large economy in the world. So I think local oriented stocks, and which includes financials, because ultimately if the GDP is to grow faster, financials have to do well. And to that extent, I think financials, having underperformed for almost a year now, should offer some good pocket of value. So that's one big area that I can think of. And even some of the construction companies, engineering companies, the cap good companies have become a bit expensive, but some of the construction linked EPC companies still offer good value. And of course, when you talk about the domestic theme, you also talk about discretionary, which is just about picking up. So the auto space, the discretionary space are spaces where we can see some more re-rating happening.
All right, Mir, what about the premiumization theme? Indians want to consume differently. Some people say that there's a slowdown. Some say, well, the way they're consuming has changed. Everyone wants a better car. Everyone wants to drink better alcohol. Maybe if you were to talk about that, wear better clothes, better shoes. So how do you play that theme?
Absolutely. So that's the second thing that we are very bullish on, apart from physical asset creation, which is exactly what you said, premiumization. And that would include, savings being funneled into the capital markets. So then we are also talking about pockets like exchanges, like brokerages, like, wealth management outfits, insurance companies.
Just to talk about that, the equity play, these brokerages, CDSL and the likes as well. How much of the good news is in the price out there? Some of these, BSE, case in point, 600-700 rupees just a short while back. It's a 2,500 rupees plus.
Absolutely. So, one can obviously debate the valuations, but the question then in that case is, what is the long-term trajectory?
Right.
Are we looking at a 5-year, 10-year kind of a growth path for these segments? Because if that's the case, then one can really take a longer-term view and, play in these themes.
Okay. So some of these themes, as Nigel was talking about, people want better cars, bigger houses, perhaps more expensive houses. Particularly in real estate, right? If you can't afford an expensive house, does it make sense?
1 minute. They want expensive houses. They want bigger houses,
Yeah.
but cheaper. Who wants expensive houses?
That's an ideal scenario where you get a bigger house which is cheaper, but that doesn't work in Bombay. But yeah, you want to tell us, if I can't afford a house in Bombay, at least I can buy the shares, right?
Certainly.
So do you think that it still makes sense to buy real estate stocks?
Certainly, because we are coming off the back of almost 8 years of stagnation in residential part. Commercial has been relatively better, but the residential did stagnate for almost 7-8 years, beginning 2013-14. So to that extent, we've just seen maybe a couple of years of uptick. And while I'm not betting on price hikes anymore in terms of as you said, the cheaper houses or expensive houses, but certainly volumes should pick up. And obviously, we should not bet on the 20 crore, 40 crore kind of ticket sizes, but the 1 to 5 crore range is certainly that some place that we can look at.
You guys were talking about the capital market plays, etc. We just spoke with Ramdev Agarwal recently, and he was also others have also made the point that this explosion of F&O on the F&O side that we've seen as compared to cash market turnover. That the difference, that ratio is some of the highest in the world, right?
Yes.
And the proportion is just very, very large as compared to the underlying market. And can this continue, or will once the new government comes in over a period of time? They'll give this a look, make it a little more sort of tougher to kind of participate on that side. We don't know. How but is that something which you think is a risk for intermediaries, financial intermediaries, especially I think exchanges, brokers, more than anything else?
Certainly, my guess is that they will they should not really tweak around with capital gains taxes.
Not capital gains.
Yeah.
Not capital
But
gains. To be
maybe
clear. I mean,
make it a little more expensive to trade. So you could see some kind of fees being levied, etc. Because even the finance minister has expressed, and we have seen many voices.
Yeah, she was in Bombay. She spoke
exactly.
about that. Yes.
Yeah. So to that extent, there might be some steps where at least it becomes a little more friction. There's a little more friction while trading. Right now, it's just too cheap.
Anything else, Meher, you want to sort of leave us with any other sort of bets or that you're taking at this point?
No, I think we are just about at the cusp of consumption having being revived. So while the government capex spending has done very well over the last 3 years, and it saw us through the COVID downturn, we are basically now betting that the other two levers, which is private sector investments and consumption, should pick up. So while the rural consumption has not really picked up, that's one bet one needs to take, because then we'll have a holistic recovery instead of a lopsided recovery, which is more towards only premium consumption.
And so QSR kind of names, I mean, from a listed perspective, or is it
QSR,
staples?
I would still consider a little more high end. I'm talking about the lower end of the real consumption, which has not really picked up. If that picks up, then we'll have a really good overall recovery.
And that will happen. You think there'll be some sort of, I don't know, hoping for too much, maybe personal tax cuts or something? I mean, to boost put more money in the hands of consumer?
So the kind of consumption that we are talking about are really low end. So probably you can see some more targeted
transfers.
Transfers, exactly.
Okay. Any of these, spaces which have seen a huge pickup lately, whether it's defense, Indian Railways, electric vehicles. We were just speaking to the management of Responsive Industries. They make, vinyl floorings for railways, and they're saying that potential is huge. Demand is picking up in a big way. So any of these spaces that you think deserve merit even now, despite the run-up?
Certainly, because these are all trends and themes which are going to last for 5-10 years.
Okay.
And these have the full backing of the government.
But they've rallied a lot also.
See, the markets always look forward, and what matters is what is the TAM, the total addressable market.
Correct.
In some of these cases, we are really just starting from scratch, So to that extent, the growth path and the runway can be much longer in these cases.
Okay, all right. We'll leave it there. Actually, Meher, stay with us. We want to just go to Ritu if she's with us, and maybe. Okay, I think Ritu will be with us in just a bit, and we want to just talk about Paytm. By the way, do you have a view, Meher? Paytm?
I mean, obviously, I can't comment on individual stocks.
Okay.
But all I can say is that when I was here last month, doing our NFO, there were three themes. We already talked about two. One is premium consumption. Second is physical asset creation. Third is disruptive business models using technology. So there is a bunch of stocks, 5-7 stocks, large stocks, which got listed in the last 2 years.
Right.
But I can see almost 20-30 more stocks which will get listed in the next 2 to 3 years.
Okay.
So that is one space where companies using technology to create new business model or disrupt existing models. That's going to be an exciting space for sure.
All right, Meher, appreciate you joining in and giving us a view on all those sectors as well as themes. And by the way, congratulations. I believe it was your work anniversary, and this month it's 30 years. So all the best.
Market, yes. So thank you so much.
And new challenges you've taken up. So we wish you well on that front as well, Meher. Well, time to move to our next management then, I think. Or do we have Ritu with us to update us on the latest in terms of what's going on with Paytm. Ritu, please fill us in.
Well, to begin with, Vijay Shekhar Sharma has reached out to several potential investors to explore a stake sale in 197 Communications, which is the parent entity of Paytm. And one of those potential investors is the Adani Group. Now, we've been given to understand from our sources that discussions have been ongoing with Adani Group, although there is no clarity on any potential closure of this deal just yet. That said, this is a stake sale in 197 Communications, the parent entity, and not the payment bank, as was also being speculated. If you keep in mind, Vijay Shekhar Sharma holds about 19% plus stake in 197 Communications, a little over 9% directly, and the rest through Resilient Asset Management. And then there have been, Chinese investors like Anfin Netherlands who hold close to 10% and have been bringing down their stake over a period of time. So it is unclear which of the investors, may sell stake if the deal does materialize. But as we understand, it is nowhere close to being done just yet. The other part is, as far as Paytm Payment Bank is concerned, there is no direct talks of any stake sale just yet. There's also been questions about what happens to the fate of the payment bank, and there we've been given to understand that some of the customer deposits are yet to move out from the accounts and the wallets. And once that process is fully completed, only then, will there be any next regulatory movement on the bank. Now, we've reached out to Paytm as well as Adani Group for a comment, about this potential stake sale, and we're still awaiting those. But meanwhile, Paytm, of course, has clarified to exchanges, saying, that it is not engaged in any discussions with respect to Vijay Shekhar Sharma's stake in 197 Communications.
Okay, all right, Ritu, thanks a lot for joining us and giving us that update on Paytm. We'll keep coming back to you as and well you get fresh updates on that front. But as promised, let's get straight to the management of Kabel. They reported actually a good quarter. Quarter 3 was a little bit subdued, but they've returned back to their growing ways in quarter 4 itself. To understand what's the outlook from here on, we're joined by Mr. Rajesh Jain, the CFO of the company. Hi, Mr. Jain. Good morning, and thanks a lot for joining in. Well, in the past year, you've grown by close to around 18%, and you've outgrown most of your peers, barring Polycap. For this year, what kind of a growth are you penciling in? And could you tell us, in terms of a market share, I think it's around 7% as of now. How do you see that panning out as well going ahead? So growth, how much comes in from FMEG, and what about the market share?
Good morning. Thanks for inviting us for this call. If you see, we have always outperformed majority of the time to the industry, and like this year also, in volume terms, our wire and cable business has grown around 20%. And even FMEG right now, that has about 12% share in our revenue. And going forward, also, we expect to grow in wire and cable around 20% volume growth. About revenue, we cannot speak because it depends on the metal prices. But in volume, we are targeting and expecting to grow at 20%.
Okay. All right. You briefly mentioned about the FMEG business as well. So could you tell us what is the revenue number we should look at in the FMEG business? And you had briefly mentioned that when you hit 1,000 crores of FMEG volume revenues, then you break even. Is that in the coming year?
So, yeah, we are expecting revenue growth and we will expect to grow and achieve the revenue growth of 1,000 crore in this FY 25. And about EBITDA, still we are not sure. We are expecting to achieve break even in next 4 or 5 quarters. And we will try our best to achieve that.
Okay, Mr. Jain, good morning and thanks for joining in. So you said 20% volume growth is your target for the next year. Can you tell me in terms of demand, right, for cables and wires particularly, what are you seeing now? Where is the demand coming in from? Is it from housing wires, industrial wires, power cables? Where is the maximum demand from?
So overall, Indian economy is doing good, and we are having good demand from domestic as well as export also. Export already contributing almost 30% in our revenue. So we have good demand from residential sector also, wire also, institutional or infrastructure sale. So this will be a mix of domestic as well as export demand.
Mix of domestic and export demand. Okay. Can you tell me particularly for export, what is the kind of demand that you're seeing? What's the export contribution currently? And in the next 2 to 3 years, how much can that grow to?
So export was always focused since the beginning of our company, and still right now it is contributing almost 30% in wire and cable business, and going forward also it may go up to 35%, but it will remain in this range only, from 25 to 35% export will be there. In export, we are getting very good demand for our cable also from Europe and other developed market, and it is doing very good.
So this 25 to 35% rise in exports, right? By when do you think you can hit that 35% revenue contribution? And would that mean higher margins for you?
Of course, see, whenever there will be higher volume growth, it will convert into margin. Since it is like 35%, we may achieve in the next 2-3 years.
All right, got that. Mr. Jain, good morning. Just a quick word on sort of underlying metal prices, right? Copper prices, which have been rising, and forecasts are that they'll continue to rise. I mean, how does that impact you? In what way?
So we have seen very much volatility in copper prices. It has gone up also, and recently in last 10 days it has come down also, and it is part of our business. So copper price will always be there, and till we can pass on the prices to our consumer, it is part of our business. So, but looking to the global demand, it seems the copper price will remain in the higher end only in near future.
Does it hurt demand, I mean, postpone demand in any way or no? I mean, if it rises
No,
to what some
I
of the
don't think
forecasts we are hearing. It's been more up than down, that you would agree. Yeah.
Yeah, but I don't think it will postpone demand because this is wire and cable is requirement. It is not luxury product. So anyway, you have to consume.
Okay, all right. Mr. Jain, I wanted some more color on this exports business, which is around 26 to 30%, as you mentioned. Earlier, I think you all were exporting wires. And then you all were looking at pushing through some cables as well. So out of the total exports, what is the mix right now between wires and cables?
So around 70% is wire and 30% is cable.
And you all are looking to change that mix?
See, we are expanding our capacities in cable mode, and we have very good demand. So it is expected that we will grow by higher rate in cable in compared to wire. But there is growth in both the sectors.
Got it. Got it. Since your FMEG business is going to gradually move towards a break-even point once you hit that 1,000 crore mark, and you're hopeful in the next 4 to 5 quarters, on a blended basis, what should margins look at? Volumes will be there. FMEG moves towards break-even. So with these levers in place, how much better can margins be in FY25 in comparison to FY24?
So we are expecting to improve our margins by 100 to 120 bips on a blended basis.
100 to 125. So it will be around 8, close to 8 to 8.25%?
Yeah, that is the range we are targeting to achieve.
All right, just one more question, sir. You have done close to around 6,600 crores. You're sounding very optimistic about business. With the current investments that you have made and the capex that you've already done, at peak levels, what can you do in revenues?
So, like capex plan, what we have planned in for FY24 and FY25, it is in line, and whatever volume growth we have planned for this year and next year, this will be we can achieve by the current capex. And now we will start working on the new capex also to meet the further demand of FY28-29 kind of business, because it requires almost 18 to 24 months to execute one capex cycle.
Okay, all right. We'll let you go on.
Just one point, Mr. Jain, on the office of the CEO, is there? Will we hear the appointment of a new CEO soon? Is that, or will Mr. Kabra continue to hold that position?
So currently this is the situation, and since this is management call, so I cannot comment right now because this will be decided very soon and will be informed to you.
Okay, and I'm not sure if you got a chance to speak with one after that announcement in April. Can you tell us what was the reason for the termination of the sort of CEO, the previous CEO?
No, this was management call, so I'm not part of that decision. So this.
Okay, all right.
This was some internal reorganization.
Okay, all right. We'll leave it there. Thank you very much for joining us, and we sort of hope to hear more from you if there is any development on that particular front. We'll take a quick commercial break here. We're back. The management of Rites, Rahul Mittal is CMD at Rites. He is joining us on the other side for more on their business. Stay with us. Later, we'll also be joined by the management of Medplus Health Services. They also reported fourth quarter earnings, so conversation coming up there as well.
Welcome back. This is Corporate Radar. Well, the market is not bad. Honestly, it's down about 75 points, but it's picked up a little bit from the lows. The mid-cap index is actually flat right now. So there is definitely some buying interest that's cropped up. Paytm is in upper circuit, up about 5%. And then you have others like, Brigade Enterprises up 4%. Real estate in general is doing well. Campus Activewear is up 12% right now. So lots of big moves coming in there. But Rites is the other one that we're talking about. It reported a muted set of Q4 numbers. Revenues and EBITDA came under pressure, while margins contracted on a year-on-year basis. To discuss this and more, we have Rahul Mittal, the Chairman and Managing Director of Rites, joining us now. Rahul, hi, good morning, and thank you for joining us. It's been a very muted Q4 as well as FY24 for you. Can you tell us what is the reason for this persistent decline that you've seen in the top line, and what is the way forward for the business?
Good morning. So let's dive into the numbers and see where the year started and where we have ended. You see, the year started with two huge challenges for us. One was an export order book of below 100 crores with no fresh export orders, export of rolling stock orders for more than 4 years. The COVID and post-COVID period, and a big shift in the quality assurance business, where 2/3 of that was from the Indian Railways, and which after about 4 decades plus was opened up to 4 players through a competitive mode. So we didn't want to get bogged down by this major challenges at the beginning of the year. We had a clear strategy to minimize the impact of these two streams of revenue. Both are high margin revenues. In fact, export is a high top line contributor to my stream of revenue. So three key aims which we had at the beginning of the year. First, to get an export order, and we've got 2 major export orders from Mozambique and Bangladesh after a gap of 4 years, as I said, totaling to about 1,200 crores in the last few months. 2, to diversify into more non-IR clients in the quality assurance business. And by the end of the year, from about 2/3 IR and 1/3 non-IR, the balance has shifted to 50% shift into non-IR, a large number of new clients. And third, to build up on our project consultancy business, which is our core strength. So that saw a 10% jump year on year. We had our highest ever project consultancy revenues. So all these 3 key focused strategies which we had at the beginning of the FY, as the year progressed, they started gaining ground. And we are confident that this has been the right direction that we are moving on.
So can you give us some numbers in the international consultancy segment, which was muted for reasons as you explained? What kind of growth can you hope to resume in FY25?
Yes, as you see, the year started with export order book of below 100 crores. Now we have 1,200 crores, 900 from Bangladesh, 300 from Mozambique. And these will start generating revenue by the third quarter. And so this year, we will build up on these 2 orders. And the way we are bidding aggressively across geographies in the export business, I'm sure that we would get some orders in the coming months also.
Got that. Mr. Mittal, good morning. Prashant here. Could you outline a fresh guidance for FY25 now? I mean, what should we expect? Top line, EBITDA?
You see, the year 23-24 was a year of consolidation, as I said, to hang on there and minimize the impact of these 2 huge challenges which are outlined. And now with these orders coming in, as also, are having maintained that trend of 1 order a day company, which we achieved in Q3. We managed to continue that in Q4. In Q4, we got 100 plus orders, totaling to 940 crores. So now we have a good enough steady base. And with now we will build up on our 22-23 benchmark, build up on that rather than 23-24. So we see a good, healthy growth on the EBITDA and bottom line, aiming for a appreciable growth on the 22-23 figures.
But what kind, if you can be specific, sir, what kind of growth? If you can put numbers to it.
Yes, what we would like to aim is that we, as we say, we are a consultancy company and we are a bottom line driven company. So we would aim for a healthy double-digit growth on our EBITDA and bottom line figures vis-a-vis the 22-23 benchmark rather than the 23-24 figures.
Okay, got that. Could you tell us what is the order pipeline now Give us a sense on that, and how many orders are you L1 in? It'll give us a sense of the visibility.
So the year ended with an order book of 5,700 crores, and we haven't added the 900 crores the Bangladesh order, which came post 31st March. So the Q1, again, we've got already these orders at the rate at which we are progressing. Q4, we were one order plus one order a day. And the rate at which which Q1 is progressing is again in that trend. So I think we will be able to build up on this order book of 5,700 crores quarter and quarter.
Okay, so when you say build up on the order book, right, what's your aspiration? Where do you think you can end FY25 in terms of order wins?
You see, I would say that this trend of one order a day, which has been achieved in Q3, Q4, would continue. So one order a day it depends on the mix of the orders. Q4 was 100 plus orders totaling to 940 crores, which depends on the mix of the consultancy order as the export order. So I think we would maintain this one order a day with a healthy blend of both consultancy and export.
Okay. And is there any impact of the RBI draft norms on project financing? Is there any impact of that on your cost of borrowings? Do you expect that to rise?
No, we are a debt-free company, so that is not impacting us in any way. So we are a debt-free company. We are a low capex company. Our business model is that we are a consultancy company, and that's why, as you see, our return to shareholders have been high. 95% plus has been our dividend payout ratio for the last FY.
All right. We'll leave it there. So thank you very much for joining us, and it's a pleasure having you here on the program as always. That's the management of Rites. The market's down 100 points still, and I just want to take a quick look at what the market, the broader market is really doing. Market breadth is, actually largely 1:1, almost 1:1. So I'll start with what's up. Mazgaon was not there in the mix in the morning, but it is up about 3% or so right now. So 3128 on Mazgaon. Campus is up 12%. So, it's basically piling on gains from, it started higher, but it's now up more. Jubilant Food, and we were talking about some of this QSR stuff. So 3 days back, stock was at about 450. It's moved up to about 515. So there is a little bit of buying which is going on here. Paras Defense is up about 6% at about 928, looking good. Sumitomo Chemicals, we mentioned. Moil is up 3.5%. And you've got Concord Biotech. I saw an upgrade, I think, this morning. Or maybe, brokerage note, 7% on Concord Biotech. After that block yesterday. JK Paper and Graphite and Exicom are some of the other names. Exicom is up about 6% or so at this stage. So that's the overall picture. Let's put the focus now on the next management. Medplus Health Services is with us. They reported a good set for the fourth quarter. Revenues are up 19%. Margins expanded as well. And the company added 174 stores in the last quarter. We'll discuss this and more with Mr. Gangadi Madhukar Reddy. He is Managing Director and CEO at Medplus. Mr. Reddy, good morning, sir. Great to have you with us here. Appreciate your time. It's always a pleasure speaking with you. So let's just get the basic numbers out of the way before we dive into what is the state of competition, discounting, etc. So you did, 5,600 odd crores in sales in FY24. That was up some 23% year on year. For FY25, how's the landscape looking and what can you do?
A similar kind of growth is what I would expect, if nothing else happened, honestly. But it's a little early. Yeah.
So, okay. But broadly at this point, sitting where you are, at least a 20% plus kind of growth, right?
Yeah, at least that much.
Okay.
And again, to get one more number out of the way, we'll most likely add another 600 odd stores. To the 600 which we added last year, yes.
Okay. And margins were 6.3% compared to 5.8. Would you keep that number 6% and more through in 25?
Absolutely. I don't see any reason for it to go down. It may not go up by too much. We will start getting benefit of scale and all as we go forward. But yeah, at least that much. And as we continue to increase our private label, I'm sure it'll get better. But yeah, I would say at least that much.
Okay. So what is the offtake of private label sales this quarter? I mean, what are you looking at? There's not been too much of a growth. I think Q4 private label sales were barely up about 1.1%. At some point, do you think you could get to high single-digit growth, and what's the view forward?
See, on the pharma side, our the net sales were around 8.5%. But you have to actually keep in mind that the current set of private label which we are selling is selling at a 55 to 60% discount, which means what we sold earlier at a 17% overall discount and where we are getting 83 rupees on a 100 rupee MRP, we're today getting only around 45. That still is profitable for us, but it has actually dropped the overall top line significantly. If you actually look at the, let us say the volume sales, GMV to GMV kind of stuff, in states like Tamil Nadu and all, where we are really focusing on by getting some advertisement in and all, we are seeing close to 16% sales overall. So this is a muted number because of the decreased top line, because of the discounts.
So how much do you want to increase the private label sales to as a percentage of overall sales? What are we looking at over the next 1 to 2 years?
For us, as I've been saying in the last 1 or 2 calls, the whole story in the pharma retail in India is now about genericization. Customers are realizing that the market basically sells a lot of Me Too products. Each product is made by, sometimes as many as 100 different companies, and there are several 100,000 brands out there. So people are realizing that, and people are seeing that, it's the same product, and they are willing to actually go with someone who can give them the right quality, and they will go with the best price, irrespective of the brand. So given that we are seeing the shift, both from the customer point of view, because there is more awareness and there's more, information out there, and given that the government is also pushing this very, very actively, I would think that that we should basically eventually be selling only private label and nothing else, honestly. But I don't know how fast the market will actually adopt. So I don't want to really speculate. I would say from the net sales of 8.5%, I would be surprised if we did not easily get into the low teens next year.
All right.
Sorry, Mr. Reddy, private label sales contribution is already about 15%, right?
I'm only talking about the pharma side.
Pharma, okay. But total pharma, non-pharma is about 15%.
It's about 15, yeah.
And what can this get up to? I mean, what would, as you said, you'd like to only, ideally, but in terms of how this goes, what can this number get to?
Difficult for me to tell you that right now. I don't know how fast the market will actually adopt. But the thing is, there's zero reason for anyone to buy anything else, honestly. Given that the government is pushing it, I think it'll go fast. This year, as I said, okay, let me just talk the medicine numbers only. Out of 100 rupees which we sell, 80 is medicines. And 20% of that today, if you look at it by volume, is actually pharma. 19 to 20%. I would expect, going forward, this, over a period of time, this can easily double. Not this year for sure, but over a period of time, this can easily go up to double.
Okay, all right. Hi, Mr. Reddy. Good morning. We've got the total number of store addition that you're targeting, but give us a breakup as of now. How many are new and how many are mature stores?
Well, as of now, I think around 15% of stores are less than a year and around 40% of stores are less than 2 years. So, yeah, that would be the number out there. What are the other breakup you want?
Got it. All right. And the margin number margin number that you're guiding for is more than 6%, but in quarter 4 to 7%. So on an average for the year, what will it be?
So for us, I'm only looking at the net EBITDA. I think, for the quarter 4, it was 4%. I'm not talking about the index number. I'm talking about the number which takes into account all the real estate and everything else. So I expect as we go forward, because of scale and everything else, we should continue to add 0.5% to 1% over a period of 1 year.
Okay.
Given that we are adding only around 600 stores this year.
Okay. I wanted your thoughts also on the diagnostics business. I think you announced that you are going to defer your plans to expand your diagnostics business. Why is that? And because earlier you had some plans to, take that business forward. But are you seeing a slowdown there? Is there a lot of competition there? Can you just give us a sense of how things are playing out?
No, it is not because of competition. Yes, definitely we want to actually take a pause and basically consolidate our story in Hyderabad only right now. See, as I have said in the past, it's a new model. It is based completely on subscription. The model is extremely sensitive to the number of subscribers. Once you have set up the network, spent the money, the more number of people you have subscribing and paying you the 1,000 or 1,500 rupees a year, the more profitable you are. There's a certain level though below which you are not. So let us say at 250,000 members, we are breaking even and making money. At 500, it'll be out of the park. But we are still there at the 140,000 number odd. So the proof is still not yet there. B2C, we're doing very well. B2B, we're not doing as well. So the focus will be on trying to get more customers to the B2B side, crossing that 250,000 number before we take a call and further expansion.
So you're at 140,000 currently. By when? Any kind of indicative timeline on when you plan to reach or when you can achieve that 250,000 number?
So on the B2C side, it's a slower growth. We have already hit the numbers we want to. We're basically operating through our 12 diagnostic centers, and we are also getting members through our 440 odd stores in Hyderabad. I don't think that's going to go up very significantly. We may add net 5 or 10,000 every month, 5,000 maybe every month is what we'd add. But the B2B, on the other hand, if you actually get the right kind of customers, coming in, you could add 5, 10, 15, 20,000 also every month. So given that we are focused only on B2B this side, and given that the sales cycle on that is much longer and slightly unpredictable, I could not tell you exactly when. But if B2B doesn't happen, then we'll probably end the year with maybe around 175 to 200,000.
Okay. Mr. Reddy, just one point. You said that private labels and so the government is also pushing this. So you're talking about on the medicines, pharma side, you're talking about branded generics, right? That's what you're largely sort of referring to in terms of a government push as well?
There are only two types of medicines. Either it's patented or not patented. If it is not patented, no matter what name you put out there, it is a generic.
No, that's fine. But branded generic, I mean, you kind of add that is what you've been sort of bullish on as well, right? You're trying to sort of increase the sales there. My only question is, that is what you were referring to. I just wanted to confirm that. And if that is, would this require sort of, a little bit more in terms of awareness if this has to really take hold? Because I'm assuming for the vast majority of people that go with, even for a simple medicine for headache, you'd go with, you'd ask for a brand, right? So when we're talking about sort of branded generics in that sense, I remember having this conversation with you last time as well. Would this require a little bit of spend on advertising, awareness, etc.? Go on.
We are doing that a little bit. Last quarter, we ended up actually spending around 10 crores. And we have spent it mostly in Tamil Nadu and all. And that has actually shown us good results. Today, 20% of all the medicines we sell in Tamil Nadu are our brand, Medplus brand. So absolutely, we have to increase the awareness and all. Now, to come to the second thing, yes, people who actually buy medicines one-off and people who buy them for, let's say, a headache or pain or some antibiotic kind of thing, small infection, will most likely go with brands. Mainly because the doctor has told them they're not going to go do research for a little bit, decrease in price. Mainly because it is not a continuing spend. It doesn't really hurt them too much. But chronic, customers who buy 1,000 to 3,000 or 4,000 worth of medicines month on month every year, they are the ones who we appeal to. They are the ones who will go and do the research. They're very, very price sensitive, obviously. And some of them get converted and basically start buying it. And the more people buy, the bigger the, I would say the spread of word of mouth.
No, I get that. We'll leave it there, sir. Thank you very much and good luck with your plans on this one and, of course, overall business as well. Look forward to speaking with you soon again. But good conversation. That's Medplus with what they're doing out there on the private labels and the branded generic side and, of course, overall. So 20% growth in FY25 revenues. Margin should be north of 6%. That's the aim for 25. Markets are still down about, 80 odd points or so. Let's sort of focus on the market a little bit. We have Sachidanand Utekar, AVP Technical Equity at Trade Bulls joining us now. Sachidanand, great to have you with us here as always. Thanks for your time. I mean, this is just sort of in a bit of a holding pattern ahead of the election results. Would you look at it like that? or would you take away anything more meaningful from the price action today and, of course, the sell-off that we saw in the last hour yesterday?
Good morning, Prashant. Yesterday we saw the Nifty, sliding back to its 5-day exponential moving average support, which is placed somewhere close to around 22,830. I think this particular level becomes a very key, important, pivotal, level for revival. So I think the way the data is placed, 22,700 looks like a dependable support. We've already seen a swing towards 72,750. And I think the reversal is quite meaningful, and we may see some more traction once the Nifty starts trending confidently above that 22,830 mark. So I think once the Nifty clears this particular level, then we may see an extension towards 22,930 during the day itself. So I think for the day, at least, there has been a meaningful support, and I think this particular support, may remain stable throughout the day. We may see a good, strong recovery in the second half, and we are expecting the expiries for the Nifty Bank at least to scale somewhere close to around 48,900, 49,000 itself. So I think both the indices have seen an intraday dip, and probably for the day, the low seems to be established, and we may see a sustainable recovery from here on.
Okay, well, individual stocks, what are you looking at this morning, Sachidanand?
Two stock ideas. First of all, we have recommended this to our clients as well. Adani Enterprises is displaying a piercing line formation on its daily scale after 3 days of a consecutive decline. We have seen a very strong recovery here. We are expecting that this particular momentum may stretch towards 33.05 during the day and probably see an extension towards 3360. And that's why we are still comfortable recommending building long positions here. The stop loss from here on should be placed somewhere close to around 32.30 on the lower side. And the other stock which has hit our radar is Asian Paints. Now the stock was consolidating near to that 2900, 2880 kind of a zone. And in the morning, we have seen a good sustainable breakout above that particular level. So we are expecting that there could be a good recovery in the stock. We may see a good pullback rally towards 2960, and that's why we are recommending building long positions here, keeping a stop loss somewhere close to around 2910.
All right, Sachidanand, we'll leave it there. Good conversation. Thank you very much, and we'll have you back during the course of the day for more. We'll take a break. Markets down three digits again, 100 points lower on the Nifty. Manisha will be joining in with a roundup of all things commodities on the other side. Stay tuned.
Okay, so for now, the market is still down. So it could go either way, actually. The Nifty is down about 130 odd points. The Bank Nifty is the one that's feeling the heat, maximum amount of heat, actually. Down almost 430 points on the Bank Nifty. And the mid-cap index, from being flat, it's taken a turn for the worse. So not looking good. The last 15-20 minutes actually have aggravated the pain in the market. The top losers today are some of the life insurance companies. HDFC Life, SBI Life are the big losers. Axis Bank, ICICI Bank, HDFC Bank. So financials actually are dragging their feet this morning. Let's see. The day is long, but for now, not looking that good for the market. But let's shift focus to the commodity space now. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Thank you for that, Sonia. I'm looking at the crude oil prices because we're looking at good gains onto this one. Last week wasn't so great. We saw 3.5% of a decline, but with the kind of surge that we're looking at right now at 84.5, it's a 4-week highs in case of the crude oil prices. It is also about the summer season demand in US. That seems to be picking up. There are some initial preliminary reports which suggest that the US summer season driving demand could be the highest in the last couple of decades. And then there is premium coming back from the renewed geopolitical unrest in West Asia. There is fighting that has escalated is between Israel and Gaza. That seems to be adding to the prices there. The markets are concerned about more uncertainty within the Middle East, and that is what is worrying the supplies in sense of crude oil there. There also are reports of yet another vessel in Red Sea being attacked, and that also the details of that are still awaited within reports, but that is also something that is bothering the crude oil markets there. The US inventory data is today, and for the last 3 weeks, we've seen constant decline in US inventories, also a decline in gasoline and distillate inventories, and that has been supportive. The markets also are looking at the OPEC crude exports for between 1st to 19th of May, and there has been a decline onto that one. They are the lowest since August 2023. So within OPEC as well, we are looking at a higher amount of agreement and compilation of that as well. If you look at the prices for Brent crude until now in this year, which started quite on the lower side at around $75. 91 has been the high for 2024 until now. We did see prices go down to 80 as well, but 84 is where we are trading at this point in time. Interesting cues coming in from the global crude demand as well, and those numbers are something that the street is looking for right now. In 2023, an average global demand was 101.9 million barrels per day. In this year, first quarter has seen a rise on that and 102. If you look at just the month of May until now, the demand has further increased to 103 million barrels per day in sense of global markets there. The demand also comes in on the back of from US in sense of Europe and in Asia as well, where we are looking at stronger numbers here. Now, this is the growth forecast estimates coming in from major agencies and the banks as well. The highest expectation clearly from OPEC at 2.2 million barrels per day, but anywhere between 1.1 to 1.7 million barrels per day of an incremental demand growth is what the street is anticipating. UBS, JP Morgan, Stancy, Goldman Sachs, IEA, all of them anticipate a higher demand globally as compared to the previous year there. Interestingly, also, there's a report from Goldman Sachs which says that the crude oil demand would not peak before 2034 and would continue to plateau until 2040. That in turn also tells you that the investment in crude in sector has been lower, and that would continue to support the prices going forward.
Okay, all right, Manisha, thanks a lot for that. Well, let's focus on a few stocks that are bobbing around in trade today. Mangalam joins us to tell us about IRCTC. The stock is under some pressure. Mangalam?
Yes, so IRCTC, while the revenues for the company this time around were good, it was the operational miss that has the stock lower in today's trading session. And the biggest one actually has come in from their key segment, which is the internet ticketing segment as well. So just to run you through the numbers, year on year, while IRCTC saw a revenue growth of around 19.7%, around 1155 crores, the EBITDA grew just around 11.7%, telling you that there was a margin dip reported by the company of around 220 basis points. The net profit was largely flat. That's because of an exceptional gain in the base quarter. But that, if you adjust for, would have grown in high single digits itself. The key segment of the company, internet ticketing out there, the revenues grew 16%, but the EBIT grew just around 5.8%, telling you that margins, which are earlier anywhere between 85 to 90%, have come all the way down to 80% itself. So there's an 800 basis points decline out there, and that's led to the overall margin miss. And also the catering business, as the operations pick up, the expenses also pick up, and as a result of which their margins come off. 34% revenue growth in the catering business has not resulted in any EBIT growth. In fact, EBIT has declined by about 3% year on year, and that implies that the margins have compressed out there by over 350 basis points as well. So all of this is something that the street does not like. Despite the revenues growing, that not reflecting in the bottom line is something that the street is taking note of, and the stock is down 4.5% on account of that.
Okay, thanks for that. But Campus Activewear is the other one which is looking really good. Mangalam, what's going on there?
Well, good operational performance out there. The revenues have picked up, yes, 4.6%, led by about 4% volume growth. Nothing really to write home about out there. There's mild improvement. But look at the EBIT. The EBITDA has grown by about 13%, margin improvement of around 130 basis points, and that's flowed all the way down to the bottom line, which has seen a growth of nearly 40%. What the company said is that it was their renewed focus on trade distribution that led to the margin growth and the revenue growth in the second half of this year. They've also, generated more cash, and as a result of which, even in a tough year, they've become net debt free by paying about 156 crore of debt, and they've reduced their working capital days from 108 to about 79. Kotak's actually written on campus this morning as well, and they've said that, these numbers were a beat on profitability. The company saw a 7.5% growth in their multi-brand outlet channel, and the management, according to them, is confident of reverting to double-digit revenue growth with EBITDA margins between 17 to 19%, as a result of which they maintain their ad rating with a target price of 285 on the stock.
All right. Thanks very much, Mangalam, for that. Well, Sudarshan is here to put the focus on a whole host of companies which are reacting to their earnings. Over to you.
So I'll start with companies which have reported weak earnings. First one is Engineers India. Profit has fallen 39%, EBITDA is down 54%, and margin has slipped almost 1,000 bips against the same quarter last year. And its biggest contributor to total revenue, that is consultancy and engineering projects, and its EBIT has halved to 96 crore. Next one is MTR Tech. It has reported very weak earnings. EBITDA has fallen 63% and margin is down more than 1,100 bips against the same quarter last year. But company says it has registered lower than estimated EBITDA in FY24 because of operating leverage was lower due to deferment of orders. But for FY25, company says it's targeting to achieve revenue growth of 30 to 35%, and that's increase against FY24. Last one is NBCC. It has reported a strong set of earnings for Q4 and led by PMC segments. EBITDA was up 130%. Margin has increased more than 200 bips year on year. Project management consultancy, which forms 91% of revenue in the Q4, and this one's revenue has increased more than 47% YOY to almost rupees 3,700 crores.
Okay, all right. Sudarshan, thanks a lot for that. Well, I'm focusing on Hindalco. That's the one that we're looking at because ahead of that Novelis IPO, they've come out with a few more details. So the price range has been fixed at around $18 to $21 per share, which means that the total dilution that they're going to be doing for this 45 million shares is around 7.5%. For this, Hindalco, since they're diluting 7.5% stake, they'll receive roughly around 6,700 to around 7,800 crores, depending on the price that you're working with. Valuation-wise, an equity valuation will be around $10.8 to around $12.6 billion. But you pull in that $4.3 billion of debt, and the total valuation is roughly around $15 to around $17 billion. Now, what does it mean? At these prices that they've come out with, the IPO will be priced at around 7.2 to around 8 times EV upon EBITDA. Some on the street are in that vicinity of around 6 to around 6.5 to around 7 times for Novelis. So in those terms, well, they're getting a bit of a premium. So that's good news. But we'll need to know what is Hindalco going to do with the 6,500 to around 8,000 crores that they will get. In all probability, it's likely to be used for capex here in India. And the good news is now Vodafone Idea is fully capitalized for the next couple of years. So no fear with regard to any money going over there. Now, post-listing, what's the problem for Hindalco from a shareholder's perspective? There could be a holding company discount that will be assigned to the stake that they have in Novelis. That's point number one. Second factor is a fourth of their shareholding is FIs. And some of those FIs that are playing it for Novelis will go directly and take exposure in Novelis since it will be listed as well. What are brokerages making of it? JPM as well as CLSA, both of them are quite positive on the stock with a target price in excess of 750 rupees odd. Well, for the time being, we'll slip into a short break. On the other side, we'll be joined by Mr. Ravi Jajkar, the Chief Strategy Officer of Allcargo Logistics. Stay with us.
Okay, welcome back. You got the market which is under pressure. Allcargo Logistics is the company that we're now talking to. Margins were impacted by one-off severance costs, and EBITDA slipped by some 31% on a year-on-year basis. But will there be better performance into the new year, FY25? We have Ravi Jhakar, Chief Strategy Officer at Allcargo Logistics, joining us to take some questions. Great to have you with us here, Ravi. Prashant this side. Thanks for joining in. So it's been a tough year, right, overall for the business. Revenues for the full year are down 27%. EBITDA is down some, 60%. What should we expect in FY25? If you can give us an overall sort of headline picture in terms of a guidance, and then we can get into the individual segments for you.
Yeah, so I think, in our business, revenue is more of a derivative of ocean freight rates and therefore relatively less relevant. We had seen the first half of calendar year 2023, which was doing okay, and then the markets and the macroeconomic environment worsened. However, if you look at the last 2-3 quarters, the performance has flattened out, and the decline which was happening previously has already been arrested. This quarter 4, FY24, has also been flattish compared to FY24 quarter 3. Now, as we move forward, there are 3 businesses that we operate in. The international supply chain business is clearly seeing the rebound that we have been estimating, and we've been looking at second half of 2024 calendar year to be stronger in terms of demand, and we already see green shoots now. We noticed that on several trade lanes, we are already seeing ocean freights rise on account of increased demand, and that means that we should see improved container utilization, and that should mean increased volumes as well as improved margins in the second half of calendar year 2024. So that's something which is looking good on the international supply chain business. On the business side, we have always been very strong, both operationally as well as from a technology standpoint. And it was largely an outcome of macroeconomic environment, which was challenging over the last 3 to 4 quarters, but that's now clearly looking up. On the domestic side, the macroeconomic environment has remained buoyant, and the challenges are more internal as we were trying to turn around the express business. And I'm glad that we have achieved what we wanted to. If you look at the express business, the costs have been reduced by almost 7% on a cost per kg basis. And a large part of that is the last quarter of the year gone by. And if you look at the March exit rates, with 7% lower costs, it has translated into improved gross profit, which is 15% higher, improved EBITDA, which is almost 115% higher sequentially. And as we look ahead, the international supply chain business would see sequentially improving performance quarter on quarter on account of revival in macroeconomic environment. And the express business would see sequential improvement on account of, all the cost reductions which have already been achieved. So from here on, we estimate that the quarters going forward should look better. Contract logistics business remains as stable as it has always been.
Can you put a number to it, Ravi? Is that possible overall?
So I would not put a number in terms of guidance, but like I said, every sequential quarter should be better from here on, and that's been our guidance for the last few quarters.
Supply chain and the express business.
Yes, for the international as well as the domestic business, both businesses.
Okay. Ravi, hi, good morning. Just a couple of more questions. In severance costs, you had said that severance costs will get concluded by August, right? Are we on track with that, and how much more is left?
Yes, we are absolutely on track with that. We have been reducing costs, and that, of course, is a impact on the severance as well. I would say this quarter has possibly seen maybe about $1.5 million overall in severance costs and other one-off cost impacts. Now, as you move into the next quarter, while there will be some severance costs with notices running into July, August, there would also be savings emanating from numbers already reduced in the quarter gone by. So I don't see major significant impact of severance costs in, say, the first quarter of FY25, maybe $500,000 they're not more than that. And second quarter should largely have no impact. And the cost reduction initiative should basically help us take care of all the escalations in staff costs on account of inflationary increases. And that means that despite all the headline inflation numbers being very high across global economies, we should be able to contain our SG&A cost. And that means that the entire gain in gross profits should go down to the bottom line. And that's the intent. And that's how we expect our margins to improve in the second half of the year.
So in terms of containing your SG&A costs, right, what's the total cost reduction? If you can give me that one number, how much are you going to reduce costs further by, and what is the impact it would have on your margins?
So various initiatives that we have taken across both in staff and general administrative expenses are in the range of about 25 to 30 million US dollars. And if you look at our total SG&A cost, which is north of 200 million US dollars, this means that any annual increments and all will be taken care of through these reductions. So that's the kind of impact. Basically, I'm talking about a 25 to 30 million dollar initiatives, which should allow us to completely offset all global increases, which would be otherwise standard in business. And that means that any expansion in business on account of volumes, improved utilization, all of that should come down to bottom line. And that's been the plan all through. And we should see the impact from July onwards on that count.
Ravi, so then, I mean, just give us a broad ballpark sort of idea. So margins were about 3.5% for the year gone by. What can this get up to as the business momentum picks up on both sides, all these cost reduction initiatives? I mean, is there an upward bias, and where the ballpark?
So I would say that, in terms of the EBITDA margins, on a volume basis, could potentially see up to 50% increase from here. It is not appropriate to look at the percentage margins because revenue is, a derivative of ocean freight rates, like I mentioned. The primary driver in this business is how well your container is utilized. And today, to share an example,
so if you can,
trade lanes from
is it better to look at EBIT?
America.
Is it better to look at instead of the percentage number, EBIT per TEU? Is that a better metric?
So there are two parts of the business. One which is full container loads which go in TEUs, and the second one which is LCL, which is in cubic meters. So overall, one is EBIT per TEU and the second is EBIT per CBM. Of course, we get the combined number. I would expect that EBIT per TEU as well as EBIT per CBM should be ballpark growing in the same range. And therefore, as we expand the volumes and the profit margins improve, there should be an outcome of, up to 40 to 50% kind of uptick should be possible from here.
Okay, all right. We will let you go on that note. Ravi, thanks a lot for joining in. Appreciate your time here. That's Allcargo Logistics. But for the market, it's actually gotten worse. So don't lose sight of that. The Nifty is now down about 160 points. The Sensex is down about 530 points. So yes, there is definitely some trepidation ahead of the election verdict. The exit polls are on Saturday. So ahead of that, there is definitely some trepidation in the market. The Bank Nifty is down about 500 points. But from the entire team at Bazaar, thanks a lot for watching. Chartbusters up next. Stay tuned for that.
Hindalco is mildly higher today in a weak market after its US subsidiary Novelis files for an IPO on Wall Street, eyeing a fundraise of nearly $1 billion. Brokerage firm CLSA issues a buy call on the stock.
IRCTC slumps despite good revenue growth in Q4 as margins come under pressure across segments. The overall margin contracts by 220 basis points on a year-on-year basis.
Aditya Birla Fashion is under pressure on the back of its fourth quarter earnings as demand remains weak. The stock also entered the F&O ban list.
NBCC surges after delivering a good set of Q4 numbers. The revenue grows by 43% on a year-on-year basis while margins expand over 200 basis points.